Weekly Markets Checklist, week 172. But before I get into it, I will read the disclaimer. Everything discussed during the Portfolio Matters podcast is for informational purposes only and should not be considered as investment advice. Listeners should be aware that we'll be discussing securities that we own or have financial interest in. Please do your own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. The full disclaimer can be found at the end. Now, before we get going, a couple of housekeeping items. First of all, Richard is sadly moving his boat today, so can't join us. He will be back next week. Thank you to Rogue Trader for the Discord call this week. We will be doing that on a quarterly basis. And thank you to all our members who joined us on that call. So the last podcast was Tuesday, 10 days ago. And since then, the Fed has cut rates by 50 basis points to 4.75%, and that has ignited a rally in equities and commodities of all kinds. We'll take you through the data. Copper and aluminium in particular have done well. The Bank of England also met and held rates steady at 5%. 8 out of 9 MPC members voted to keep rates unchanged. Elsewhere, the OECD has upgraded its forecast for UK economic growth to 1.2% for 2024 and to 1% for 2025. The UK economy is resilient, but it's not growing strongly. And Keir Starmer has pledged no return to austerity in the coming budget. Expect tax rises as they won't be cutting spending much. China has attempted to stimulate its economy with a broad range of monetary measures. We'll take you through the details. That also contributed to the rally in copper. In the Middle East, Israel and Hezbollah seem to be heading towards all-out war, but that hasn't really had any effect on the oil price. Gold continues to rise to all-time highs, and the reason that oil is falling despite the Middle East tensions is that Saudi Arabia is reported to be ready to abandon its $100 a barrel price target. And we've previously described how it is intending to increase production by 2.4 million barrels a day in the year starting in December. Well, it seems to be committed to that. Now, the oil market is already in balance, and there seems little prospect that it'll be able to increase production without driving down the price further. To add to the woes of the oil market, the Libyan factions this week also came together to appoint a new central bank governor, and that should ease the oil payments crisis and allow the resumption of oil exports to the tune of 700,000 barrels a day. Oil looks structurally weak. During the week, I did a podcast specifically on the oil market. Please check it out. Spoiler alert, there seems little prospect of a rally in oil prices in the near term or even the medium term, frankly. Some charts relating to the news. Well, first of all, the Fed cut rates. Market had been expecting a 25 basis point cut. They cut by 50. China also cut. Now, so far, it's been cutting rates for 5 years, and the economy has continued to weaken. Will the latest cut make any difference? Also cut back reserve requirement ratios in a bid to stimulate more bank lending. These are Chinese bond yields. Chinese bond yields rose briefly, but then fell again. The bond market was unconvinced the stimulation measures were sufficient. However, the Chinese stock market is off to the races. We'll show you the data. So this is the oil price. If Saudi Arabia follows through with its plans to allow OPEC Plus to increase production by 2.4 million barrels a day starting in December, then the oil price looks like it's going to be very structurally weak. And these are its plans. Steady increase month on month to get to an increase of 2.4 million barrels a day over the course of the next year. And on to this week's economic data. So, quick summary: UK is resilient, but weak with little sign of strengthening. The EU economy is weak and appears actually to be weakening once again. The US economy is strong. Labour markets show definite signs of weakness, but there are signs that weakness may be coming to an end. China is weak. Will the latest stimulus have any effect? Actually, we don't think much. Okay, so starting with the UK. So last week we had CPI numbers and they were okay. So the headline CPI number came in at 0.3% in August, matching expectations. Year on year, inflation was unchanged at 2.2%, which is a decent number. Core, however, was more concerning. It met expectations in August of 0.4% month on month. Annualized, that is not a great number. And year on year, inflation was at 3.6%, bouncing from July and above expectations. RPI was at 0.6% in August, missing expectations, not a good number, and 3.5% year on year, although that is down on July. Input price inflation continued to be negative both month on month and year on year. So factory gate inputs were negative. That's good news. Output going nowhere. Again, that is good news. Now, the reason that inflation rose month on month in August compared to July was largely due to airfares, which rose by an astonishing 22% month on month, primarily on European routes. And this is the contributions to the change in CPI between July and August. And you can see transport was the big one. Without airfares, inflation would have dropped. So let's hope airfares fall back again in the autumn. The good news is hotel and restaurant inflation continued to decline, and that has been a big contributor to the rise in inflation over the past few years, and that is great news. But overall, service inflation remains far too high and sticky at 5.6% year on year. Retail sales in August were good at 1% month on month, up on July and well above expectations, and the July number was revised up. That meant year on year, retail sales grew by 2.5% real, which is well above expectations and above July. So the UK consumer seems to be doing better. We had the PMIs and they weren't great. So previously, UK manufacturing has been outperforming manufacturing elsewhere in the world, according to the PMIs. Well, September print was poor, still in expansion, but below expectations, below August. Services also faded, and 52.8 is a decent enough number, but it's below the long-term average. So it's saying that services activity is still in expansion, but relatively weak compared to history. And that meant the composite fell from 53.8 in August to 52.9 in September, below expectations. However, as we've said many times, there seems very little actual relationship between the PMIs and real economic activity. UK consumer confidence fell sharply. Now, the commentary is that is because people are concerned about the mood music coming out of the new Labour government, who have warned us to expect a difficult budget. So people's confidence has fallen in advance of that. Reminder, the budget is on the 30th of October. Manufacturing new orders, not great. falling sharply in September to -35. The public sector borrowing requirement was very poor at -13.7 billion in August, worse than expectations. Car production, that looks very poor, frankly. Traditionally, August is the holiday month where car production is low anyway, but it was slightly better than expectations, actually. But if you look at it in the context of history, UK car production seems to be in structural decline. The Citigroup Economic Surprise Index fell sharply, so the UK economy is no longer outperforming expectations. The Indeed Job Postings Index ticked up a tiny bit, but there's no sign of a sustained improvement in job openings. So average wages on the Indeed website were 6.7% up year on year. That is way too high to be compatible with the Bank of England's 2% target. The markets are concerned that UK inflation is very sticky, and this is good evidence of that. So on the Discord, I had an exchange with one of our members, Zendigan, about the prospects for UK growth. And I looked up the actual data. So this is UK growth year by year over the past 60 years, actually 70 years. And if you look at the average growth rates decade by decade, you can see UK growth has been slowing. In the 60s, it was 2.8%. In the 2010s, it was 2.0%. Now, the reason that growth was slower in the 2000s than in the 2010s is that 2008 and 2009 were affected by the great financial crisis, and essentially some of the growth from the 2000s was shifted into the 2010s. So the bottom line is, since the millennium, the UK economy has been growing at an average of less than 2% per annum. And you see, we are currently below even that. And there seems to have been a structural break in UK productivity after the great financial crisis. See, pre-great financial crisis, you could argue that we were on the blue line, the trend in productivity. Whereas since then, there has been a clear break and we are on a different trajectory. Now, if UK productivity had continued to grow on the blue line, GDP per capita would now be £41,800 per head per annum, compared to the actual £33,500, i.e., we would be almost a third better off. So that drop in productivity growth has had real economic consequences and has reduced the wealth of the country. Thank you to Wayne J for sending that, and also for sending a link to the article from UK Foundations. The link is bottom right, who argue that the drop in UK productivity is due to a lack of investment. Let's see if the new Labour government can lift investment. Okay, so UK summary. Well, inflation was unchanged in August at 2.2%, but core continued to be far too high. Inflation is coming down, but wage inflation is sticky and far too high to be compatible with the 2% target. Interest rates will have to remain higher for longer until wage expectations return to trend. PMIs were weak, but retail sales stronger than expected in August. Bottom line, the UK economy has outperformed expectations, but the PMI suggests it is losing momentum once again. The budget is on the 30th of October. And onto the EU. So EU confidence, consumer confidence, actually ticked up a tiny, tiny bit in September. And by historic standards, that's a decent enough number. The PMIs, though, were poor. Manufacturing is fading once again, and that is a clear trend now. Having bounced towards the end of last year, manufacturing in Europe is once more deteriorating. Services, similar trend. Bounce earlier in the year and now clearly fading, and now at 50.5 in September, and that is just above expansion. So that meant the composite fell to 48.9. According to the PMIs, the Eurozone is heading back into recession. Loans to companies grew 0.8% year on year, slightly positive, but not good. Credit growth to households grew by 0.6% year on year, again, not really very good. M3, 2.9%. So the money supply is growing once again in the Eurozone. The ZEW Economic Sentiment Index, which is a survey of economists, is following the PMIs and showing clear signs of deterioration. The Economic Surprise Index fell back to minus 58. So the Eurozone economy is underperforming. The good news, though, is the GDP nowcast has risen to minus 0.3% for Q3. So the data suggests the Eurozone is in contraction this quarter. Now, last week, we showed you this chart, which shows that the French fiscal deficit is well above the 3% target. And unless the new Prime Minister Michel Barnier can get an austerity budget through Parliament, it's going to deteriorate further. Now, the markets are concerned about France. We've talked about this before, that it has very high fiscal deficit and debt to GDP ratio. French bond yields are rising relative to German ones. So you can see that there's been a big step change in the premium the market charges for lending to France since Macron called the snap election and lost control of Parliament. Now, the new French Prime Minister, Michel Barnier, must soon present a budget to Parliament where the socialists are the biggest bloc and where they have vowed to topple the government at the earliest opportunity. Meanwhile, the European Union has put France in a special procedure designed to enforce stricter fiscal discipline in countries deemed to have excessive debts and deficits. Watch this space. France seems to be headed for some sort of political and maybe economic crisis. All that has meant that French 10-year yields are now above Spain's. This is the German employment PMI, and that's in red, and the European employment PMI is not doing well, but the German one is awful. The good news is inflation is expected to keep on falling, not surprising if the Eurozone economy is weakening once again. The European population is aging and without immigration will start to decline in the next few years. That is the green dashed line. If the current levels of immigration continue, then the European population will peak sometime in the 2030s. But both the UK and Europe appear to be pushing back on current levels of immigration and attempting to reduce them. And that will mean a more aging population and population decline, which would be bad for the economy. Now, I thought this was an absolutely astonishing chart from the FT. We've talked previously about the sacrifices the periphery have had to make to stay within the Eurozone. Now, the red line at the bottom is Italian GDP. And now, 15 years after the great financial crisis, it has finally regained its pre-GFC levels. So the countries of periphery have made extraordinary sacrifices to remain within the Eurozone. So EU summary, PMIs were weak. Economists are more pessimistic about the outlook for the Eurozone economy. Consumer confidence, though, is weak but improving. So the Eurozone economy has so far proved resilient, but it's showing no signs of improving and may be weakening once again. So the Fed cut interest rates from a range of 5.25% to 5.5% to a range of 4.75 to 5%. So a 50 basis point cut. But as inflation falls, the real rate paid by small businesses has actually been rising. You can see that US small businesses are not really benefiting from the cut in interest rates yet. We had retail sales for August, and they were better than expected at 0.1%, well down on July, but the markets had been expecting them to fall. Year on year, they came in at 2.1%, slightly below expectations. Industrial production in August was much better than expected, bouncing back from July. Year on year, it was flat. Worse than expectations, not great. Durable goods orders in August were 0, which was much better than the fall expected after an excellent July number. Excluding transport, they were up 0.5%, and that's a decent number and better than expected. The PMIs, well, manufacturing faded again down to 47, and that is a bad number. So all the global manufacturing PMIs appear to be fading again. It looks like manufacturing is not doing well, and that can probably be explained by the fact that China is attempting to export its way out of trouble. So all the manufacturing competitors around the world are suffering from Chinese competition. Services weakened slightly, but that is still a very good number at 55.4. Little sign that the US economy is slowing. That meant the composite was at 54.4, down on August, but still a very good number. Chicago National Activity Index was at 0.12 in August, up on July, and that meant in August, the US economy was expanding faster than normal. Reminder, the Chicago National Activity Index is measured in standard deviations. The National Association of House Builders Index ticked up a touch in September, but that's still not great. Building permits, though, rose in August in expectation of the interest rate cut, which came. Housing starts bounced back strongly, well above expectations and well up on July. Existing home sales, though, continue to fall below expectations and down on July. Case-Shiller house prices were flat in July below expectations, and it does seem that the surge in house prices we saw in the second and third quarters is now at an end. And year on year, that put house inflation at 5.9%. Housing affordability in the US is terrible. We had the Conference Board Leading Index, and that was at minus 0.2 in August. Bit better than expectations, still negative. And that was primarily due to the continued weakness in new orders and the yield curve. And all that meant that the leading index fell back into signaling a recession. But we were there for a very long time in 22-23, and there was no recession, and there seems very little indication a recession is coming anytime soon. The Conference Board Consumer Confidence Index fell back to below 100, but that's a volatile number. Their assessment of their current situation does appear to be deteriorating, though, and consumers are increasingly concerned about their ability to get a job. So the black line is the number of correspondents saying jobs are plentiful, and that has been falling. And the number saying jobs are hard to get has been rising. Although the gap between the two is still very positive. Now, historically, there has been a strong relationship between the labor market differential which is the gap between those two lines I've just shown you, and the unemployment rate. So the labor market differential is deteriorating. Will the unemployment rate continue to follow it? Initial jobless claims last week continued to fall, although that number was above the seasonal norm. Continuing jobless claims rose a touch. Onto the nowcasts, and they are all fine. So Dallas Fed at 2.3%, Atlanta Fed at 2.9%. The New York Fed strengthened considerably to 3%. St. Louis Fed 1.55. So all the nowcasts portraying the US economy doing just fine. The economic surprise index improved to -14. Job postings, that appears to have plateaued. There's now a few months with no further deterioration. Is the weakness in the job market coming to an end in the US? Now, the equity market appears to be anticipating a rebound in job openings, as human resources employment companies have done well over the last month or so. Wage growth in August bounced back a touch at 3.3%, but that is a number that is perfectly compatible with a 2% inflation target due to the strong productivity growth in the US. Trueflation bounced back to 1.4%, but still, that's a good number. Now, the CBO estimates that there are 3.3 million immigrants into the US in 2023, and most of those don't have a permit to work, but will almost certainly find work in the casual sector. And that has helped to ease wage inflation in the US. That surge in immigration is now at an end, as the Biden administration has cracked down on illegal border crossings, which have now returned to normal levels. So the cut in interest rates has led to a fall in the 30-year mortgage rate to 6.2%. And the purchase index has ticked up a tiny bit. So have home buyers started to respond? Reminder, the US fiscal deficit is awful and out of control, and whoever gets into the next government will need to try and do something about that. And to add further pressure to the US fiscal balance, the Social Security Trust is now in drawdown and will be entirely depleted by 2035, according to forecasts, and that pays old age survivors and disability insurance. And so an alternative means of payment will need to be found by that date. Now, we talked previously about EU demographics. Well, the US is doing much better because it's got much more land and allows in vastly more immigrants. And it is forecast to keep growing till 2080. So the US economy is likely to keep outperforming Europe for a long time yet. Now, these are the Fed's projections for GDP growth, employment, inflation, and its own Fed funds rate over the coming years, and it thinks soft landing and no recession in the foreseeable future. So US suddenly, the Fed cut rates by a full 0.5%. Inflation very much looks under control. The economy appears resilient. So what is the impetus for the US to cut rates further? Unless you get a further deterioration in the jobs market, there doesn't really seem to be one. Unemployment claims are rising, but only very slowly. Bottom line, looks like a soft landing. And on to China. Well, we had no new economic news this week, but we have a few charts. Now, this is Chinese government spending, and it is down 2.9% year on year. So although the Chinese government has announced monetary stimulus, they have not announced fiscal stimulus. And the problem is that in the bursting of a property bubble, everyone has got debt, which they concentrate on paying off. And so cutting rates to try and get them to take on more debt is generally not very effective. It's called a balance sheet recession, and it's what Japan suffered from in the bursting of their own property bubble. And it took about 15 years for Japanese corporates and households to rebuild their balance sheets and for monetary policy to regain effectiveness. I thought there's an interesting piece of hard data on how the Chinese economy is doing. This is air pollution in Beijing. Air quality has been improving, and that is likely to mean that industrial activity in the Beijing region has been falling. And this is the nowcast, which looks at hard data, i.e. not official data in China, and it's not great. It's showing that activity is below average. Now, talking about demographics, and thank you to Jaw It for sending me all these charts, the Chinese population is going to start shrinking at an accelerating rate because of the falling birth rate. So China faces lots of economic headwinds in the coming years. And as further evidence that the Chinese economy is not doing well, oil demand is down year on year. That does not help the oil price. So summary for this week, no new data for China out, but they have announced a big stimulus package. We're skeptical that it will work. Now, what were the stimulus measures China announced this week? Well, the People's Bank of China cut the reserve requirement ratio of banks by 0.5%, and their 7-day policy rate from 1.7% to 1.5%. And also they cut mortgage rates. The aim was to boost lending and reduce interest on existing loans. They've also stated that further cuts to reserve requirement ratios were possible. They also announced a 500 billion yuan, i.e. 71 billion, the support package for the equity market. Hence, equities are off to the races. The China Securities Regulatory Commission also stated that new measures to encourage mergers and acquisitions will be unveiled soon, and the National Financial Regulatory Administration will add Tier 1 capital to 6 major commercial banks to help them lend. So the reaction was that analysts welcomed the stimulus, but they didn't think it would be enough. Lower mortgage rates will help homeowners, but house prices are falling and there are lots of unfinished apartments in China. Once confidence has flowed out of the property market, it is very difficult to get it back, and cutting interest rates from 1.7% to 1.5% is unlikely to be enough. Our thoughts, well, pushing on a string. Monetary policy is ineffective in a balance sheet recession. If nobody wants to borrow, then you can cut interest rates, you still won't stimulate loan demand. I think the fact that Chinese fiscal spending is down 2.9% year on year when the economy is struggling is very relevant. If they want to get the economy going, they need to start spending money and increase the fiscal deficit. But they face a problem in that a lot of the local authorities fund themselves through land sales, and the slowing property market means that their revenues have fallen. So the Chinese economy, as we've described many times over the last few years, has resembled a Ponzi scheme, which is dependent on ever increasing property prices and property sales to fund local governments. Now that's all come to an end. And while we talk about China, last episode, we had a puzzle. Chinese M1 was shrinking, but M0 and M2 were continuing to grow. So this is M1, which is falling, M2, which is growing. And I asked if anyone knew what was going on. And thank you very much to Mr. C. Peckham, who once again got in touch to explain what's going on. Now, the way China defines the money supply is quite odd. So China defines M1 as cash in circulation plus enterprise demand deposits. Now, normally M1 is cash plus demand deposits, but China defines it as just the deposits of companies. Household deposits are included in M2. So M2 in China is defined as M1 plus companies' fixed-term deposits and household deposits in the entirety. So household short-term and fixed-term deposits. Now, a quick reminder of how the banking system creates money. So you deposit $1,000 in the bank, and according to the reserve requirement ratio, you put aside $100 of that and lend out 900. That assumes the reserve ratio requirement is 10%. The recipient then has $900, an extra $900, which it deposits in the bank. And the process starts again. So the banks are responsible for creating money. And you can control the extent to which they lend by manipulating the reserve requirement ratio. A higher reserve requirement ratio means they can lend out less. Lower means they can lend out more. And hence, Chinese have been lowering the reserve requirement ratio as part of their stimulus efforts. So why is M1 falling in China? Well, there are two alternatives. Firstly, companies could be moving cash from their deposit accounts to fixed term accounts, and that will result in M1 falling, but leave M2 unchanged. Or corporate bank balances are falling. Reminder, only corporate demand deposits are included in M1, while household deposits continue to rise. And that means M2 would be rising because it includes household deposits, but M1 would be falling. And that would require household deposits to be growing more than the fall in company deposits. Now, that can happen if corporate profits are falling while households are hoarding cash and not spending. And as Mr. C. Peckham points out, that process can indicate the start of a recession. He says, as the recession begins, corporate profits reduce, perhaps because households are hoarding cash, while households are unaffected, i.e., they still get paid their wages. Ultimately, corporates will react to this fall in profits by sacking workers, but that happens later in the recession cycle and helps worsen the recession. Now you'll see this chart shows that Chinese consumers are moving their deposits into time deposits, which is the bright red bars, and reducing their demand deposits, but that should not affect M1. If enterprises are doing the same, it will affect M1. And what that indicates is that consumers are not intending to spend anytime soon. And if enterprises are doing the same, it implies that they aren't either, and they're not intending to invest. Now, another reason that M1 is falling is the Chinese regulator is attempting to wring the water out of the financial system by tackling the empty circulation of funds. So this is believed to refer to cracking down on the bank's practice of inflating loan growth figures by creating loans that merely flatter the bank's performance without actually funding any real economic activity. So they create loans, and then, which shows the regulator they appear to be doing something, but those aren't real loans funding real economic activity. And further to our earlier discussion about how banks create cash, if those loans were not real and are then paid off, then you are reducing the money supply, M1. This is Chinese new loans. New loan growth is negative year on year. outstanding loan growth is in decline. So cracking down on fake loans is resulting in deteriorating loan growth. So in summary, the reason why M1 in China is falling, whereas M2 continues to rise, is a puzzle. Either corporate bank balances are shrinking while household balances have continued to rise, and that may be the precursor to a recession because corporate profits are falling while households are continuing to receive their wages and to save them. Or corporations are moving money from deposit accounts to time savings accounts. And that would be a negative for the Chinese economy as well, because it indicates that that corporates are saving money rather than investing it. Special thanks to Mr. C. Peckham for all of that. Now, he also makes a further technical point, which I thought was quite interesting. So, reminder, the definition of M1 is notes and coins in circulation plus deposit accounts, the money in deposit accounts. Now, when governments issue bonds, they take money out of the banking system and put it in treasury, and that is not included in M1 or M2. So whenever a government issues a lot of new government bonds, they temporarily depress M1 and M2 until they spend the money. And onto one chart. I have been totally wrong about the outlook for the equity market over the last year, and I thought that AI stocks were ludicrously overvalued. Well, the trouble with buying stocks with extreme valuations is illustrated by this chart, which shows the performance of the dot-com stocks from the peak of the bubble in 2000. And the dot-com darlings actually did experience extraordinary revenue growth in the following 20 years. Their revenue was up tenfold, but their equities, and that's the bottom lot graph, did very little over that period. Their shares collapsed in the immediate aftermath of the bursting of the bubble, and 20 years later are only up 16%, i.e. annual return of less than 1% per annum. And that's because all the future growth had already been discounted by the market 20 years ago. I expect the same thing to happen to Nvidia. And I'm having a terrible year, but one person who's got it right is SimonW, and I've asked him to have a look at gold, which is doing incredibly well. This is the monthly chart, and Simon is saying that gold should rise to around $3,000 an ounce based on his reading of the current chart. So gold has momentum. According to the weekly chart, gold has broken out of its previous pattern and it's in a new trading pattern, which, looking at the daily chart, it could be in a new channel. Now, it's at the top of that channel currently, which suggests that it may be overbought currently. So, medium term, gold looks to be in a strong rising channel, taking it towards $3,000. But right now, it is at the upper end of its current trading channel. So it is due a bit of a pullback. Now, the S&P 500, previous weeks, Simon was warning that it had broken out of its previous channel and was now looking for a new range. Well, it has broken out to the upside. And if the market continues to rise, then it looks like it's formed a new upward channel and will continue to rise. The Nasdaq, however, has broken out of its downward channel, but failed to regain previous highs. He says he's less convinced by the Nasdaq and prefers the S&P 500. Now, a couple of episodes ago, we looked at one investment trust. That was the TRIG, the Renewables Infrastructure Group. And this week, I've been very busy buying asset-backed investment trusts. So we're going to have a look at another. This one is the International Public Infrastructure Fund, PLC, ticker INPP. Now, it invests in global public infrastructure projects with the aim of delivering sustainable inflation-linked returns with the possibility of capital appreciation. It was listed in 2006 and has a solid history of delivering good returns. You see, it's diversified both in terms of industry and geographically, although the majority of its assets are in the UK. These are some of the projects it has funded. Bottom left, Tideway, that is the London Super Sewer, which should be operational next year. And you can see it has rail infrastructure, gas infrastructure, energy infrastructure, personnel housing, that's in the US, and these are electricity transmission stations for offshore wind. Now, the Diablo project, which is mentioned on the previous slide, is typical of the sort of things it does. So it is rail infrastructure which connects Brussels Airport with central Belgium. They have 100% equity ownership for the next 35 years when it reverts to the state. During that time, they get guaranteed income. And this is the share price and the NAV. And what I really like about these is both are highly sensitive to interest rates. So it currently yields 6.58% and has a discount to NAV of 13.6%. Now the NAV, because you value the assets on the discounted cash flows from them, as interest rates rise, so your NAV falls. And also, the share price has fallen at to a discount to the NAV. Now, as interest rates normalize, you expect the NAV to rise because interest rates are falling and discount rates falling, and the premium, the discount to the NAV, to also narrow. Historically, it's operated at a premium to NAV. So it's highly exposed to interest rates. I expect interest rates to go down, and in the meantime, I'm getting paid 6.6%. This is the dividends, which have been growing steadily over the years. And this is from the last annual report. The company reconfirms that the projected cash receipts from the company's portfolio are such that even if no further investments are made, the company expects to be able to meet its existing progressive dividend policy for at least the next 20 years. The UK market has not done terribly well. So INPP has strongly outperformed it despite poor performance over the last couple of years. If you look at its share price since inception, it's up 209% compared to 144% for the all share, 63%, shocking for CPI. The NAV has done even better. Currently has a £30 million share buyback program. And this is the premium or discount to NAV. It used to operate at up to a 20% premium to NAV. Now it's almost 20% discount. I'm expecting that to narrow as interest rates normalize. And if you look at the fall of the NAV over the past year, this is a year to 2023, it was all due to rising bond yields. And this is the handback dates, i.e. when its licenses to run the infrastructure it has funded run out. And you see that it's in the 2030s and 40s on average. So these are long-term assets, which means it has very predictable cash flows for years to come. So bottom line is, This looks like a very sensible investment that will deliver good inflation-linked returns. It currently yields 6.6%, and historically it's targeted annual returns of 7%, although it's now replaced that with a more flexible approach. I bought some at 127, and I will be continuing to add to it in the coming weeks. Frankly, I have been, as you know, buying long-dated government bonds, and that's been a total disaster. And I've not wanted to buy equities because I think they're overvalued and they continue to rise. And, I'm getting killed while everyone else, I hope you are, all making money. But this is the most compelling investment opportunity I have seen in a while. And so I am moving all my cash into REITs, and I will get 7% per annum, inflation linked, and my portfolio will then be entirely REITs and long-term government bonds. So in essence, I'll be highly exposed to interest rates. But as we talked about it earlier, UK economic growth for 2024 is forecast to be 1.2% and 1% for 2025. Now, that is evidence to me that the UK economy can't grow properly at high interest rates, and we need to get wage inflation down. But I see that as a lagging effect. And when wage inflation comes under control, I expect the Bank of England to be able to cut rates. We need lower rates to allow the economy to grow. Now, on that point, R star, the natural rate of interest, what is it? Is it structurally higher post-pandemic? Now, I have previously expected the neutral rate of interest to fall as the population ages, and this chart shows why. Lower fertility means lower demand for capital, and higher longevity means more savings, more supply for capital. So you get a shift downwards in R star. Now, reminder, R star is the real rate. So you had to have inflation to that. And if you look at the Fed governor's estimate of long-term interest rates, they put it at somewhere between 2.25% and 3.75%. Now, if you assume inflation is 2%, that implies R star is somewhere between 0.25% and 1.75%. Blue band at the bottom is that range. You see that R star estimates have been trending steadily down over the last 60 years. The latest range implied by the Fed governors shows that they think it continued to decline. The market is expecting US interest rates to hit a low of 2.75% in 2026. So they're expecting a soft landing and no need for the Fed to cut rates below R star. Now, GavCal research think that R star is likely to be structurally higher following the pandemic. They argue that US households and companies have stronger balance sheets, i.e., they have delevered thanks to fiscal largesse, and that means they can re-level. They can borrow more once again. And they also argue that long-term changes in the capital intensive of industry, in geopolitics, in fiscal policy, and demographics are moving the economy away from one of excess saving and secular stagnation towards higher investment and lower savings. And this is private sector debt to GDP ratio. And yes, indeed, the pandemic did allow private sector deleveraging in the US, which means they've got the capacity to borrow once again. What do I think? Well, I have been betting that long-term interest rates will come down. And so far in the UK, I've been all wrong. And I think GavCal make two good points. First of all, corporate and household deleveraging has occurred, and that means that they have renewed appetite for borrowing, and R star may rise because of that. And also, and I think this is the big one, fiscal deficits have risen substantially from pre-pandemic, which again increases demand for savings. I don't find their other arguments convincing. In particular, I don't see an increased demand for investment. European and US economies are increasingly service-orientated, not manufacturing-orientated. And deglobalization is more talked about than it happening in actuality. And fundamentally, in the UK and Europe, we have aging populations, and that first chart showing how declining demographics leads to falling R star, I would think remains pertinent. But R star is likely to be higher than it was pre-pandemic, and onto recession watch. So this is the non-farm payrolls diffusion index. So it looks at how many industries in the US are losing jobs and how many adding them. And you can see there's a clear deterioration. It shows that employment growth in the US definitely is deteriorating. And further evidence of this, the Paychex company processes payments for companies in the US with less than 50 employees. And it shows that they've actually been shedding jobs in August. The trend in payroll growth for small companies shows a clear deterioration over time. Consumers are dining out less in the US. That's a surprisingly weak number outside of recession. And their income expectations have absolutely collapsed. Small business profitability from the National Federation of Independent Businesses survey is very poor. And the ratio of full-time workers to population is falling. And again, that is rare outside of a recession. Global manufacturing PMIs are rolling over once again. So beneath the headline numbers, it's clear that the poorer US consumers are not doing so well, and that US employment growth has been weakening. Although, as you saw earlier, the Indeed job postings number appear to be stabilizing. Rising US interest rates failed to slow the US economy. Why should falling interest rates stimulate it? And onto other charts. Now, this is the response rate to various US surveys. And we previously talked about how the JOLT survey in particular had suffered from a huge decline in response rate, leading to questions about its reliability. Well, the good news is response rate has stopped falling. The bad news is it's still at a very low level. And good news. Now, this is interesting. So this is a graphic of a lithium-ion battery. What you need to know is that in order to produce electricity, lithium ions physically move from the anode to the cathode, and electricity flows from the cathode to the anode. Lithium ions physically move within the battery. Now, we all know that lithium-ion batteries decline over time, so they lose capacity. And it was previously thought that was because lithium ions that are physically moved from the anode to the cathode, not all of them returned to the anode. So over time, you had a loss of the number of active lithium ions in the battery and a loss of capacity. But now, researchers at the US Department of Energy have shown the problem is actually entirely different. What they've shown is that hydrogen molecules from the breakdown of the electrolyte occupy spaces within the cathode and therefore stop lithium ions from the anode from entering the cathode. So the problem is not lithium ions at all, it's hydrogen molecules. And now they understand what's going on, they can take countermeasures, so changing the electrolyte or stopping hydrogen ions from entering the cathode. And that means you get longer life lithium batteries. Good news for the energy transition. And onto equities. So generally a very good week for equities and Bitcoin. All world index up 2.9%. Stocks, Euro stocks up 2.1%. Despite, and I've just shown you the data, the Eurozone economy appears to be weakening. The S&P 500 up 2%, Nasdaq up 3.4%, the Hang Seng up an enormous 16.3%, and the topics following it up 7.2%. Bitcoin up almost 12%. Sterling doing well, up 1% versus the dollar. And all that meant VIX fell back into complacency territory. So this is the all world index, all highs for the year. The all share not really joining in very much, but still up 7% on the year. Euro stocks doing amazingly well, up 9.8% on the year, despite the Eurozone economy going absolutely nowhere. S&P 500 up 20% on the year, up 2% on the week, new highs. The Nasdaq not at new highs, but still up 20% year to date. Russell 2000 up 9% year to date, but interestingly, not showing the momentum of the S&P 500. Hang Seng absolutely off to the races after the Chinese stimulus measures, and in particular, the measures they announced to support equities have sent the market up 16% in the last 10 days, up 20% year to date. The topics followed it, up 7%, up 16% year to date, so reversing recent weakness. Bitcoin also joined in the general risk-on rally, up 12% in the last 10 days, up 54% year to date. Sterling, persistent UK inflation leading to interest rates that are higher for longer means that sterling continues to rise versus the dollar, up another 1.2% over the last 10 days, 4.9% year to date. Eurozone not doing so well. Euro unchanged. Meant the dollar index stopped falling, unchanged the last couple of weeks. Charts related to equities. Well, I have got the equity market totally wrong, as you all know, over the last year. And I was expecting the US economy to slow, which it hasn't done. But the equity market has far outperformed earnings. You see that when you look at earnings per share on a generally accepted accounting policies basis, they're only just back to their post-pandemic highs. They've having fallen in 2022, and growth has not been strong. Market seems well ahead of the fundamentals to me. And since the jumbo rate cut from the Fed, markets have assumed that that will lead to a recovery in the cyclical sectors. So financials, real estate, all doing well. And leadership has moved from IT and communications, which, NVIDIA, etc., had previously been the leaders. Now, if there's no recession, the lesson of history is the S&P 500 can continue to outperform. But valuations are very stretched and market concentration is extreme. And generally that means poor future returns. Valuations now are just as extreme as they were before the last big drawdown in 2022. 90% of S&P 500 sectors are in the top quartile of their historic valuation range. This is an expensive market. Hussman Advisors estimate the US stock market relative to its discounted cash flows is at record overvaluations. But If the Fed continues cutting and corporate earnings growth accelerates, as it's expected to do, the stock market can continue to rise. Hedge funds, though, are bearish and have been adding to their net short positions. You'll see, though, that they've been bearish throughout the year, which seems odd. Continuing puzzle to me is European stock markets. European economies not doing well. DAX just hit an all-time high. On current trends, the passive managers will own around 40% of the US stock market by 2038. And reminder, they don't care anything about the earnings or any information about the company. Will that start to undermine the efficiency of the market? But long term, staying in the market is the best policy. I'm looking very foolish having got out of the market. That all said, periods of extreme overvaluation lead to long periods in which the market does nothing at all. SimonW's technical analysis would seem to suggest that the US stock market continued to rise despite very high valuations. Reminder, the yield curve continues to forecast a recession that looks unlikely to arrive. But currently, the stock market appears to be ignoring the fundamentals. Corporate profit margins are at all-time highs, and consensus is for earnings to accelerate over the next year, 18% earnings growth. Now, how are US corporates going to manage that when corporate profit margins are already at an all-time high? I am skeptical, but I've been totally wrong for the whole of the last year. On to commodities. Well, mixed week. Oil was very weak following the announcement of Saudi intends to open the taps. Natural gas, though, was strong. Industrial metals and precious metals were both strong. So looking at energy, oil continued to be weak. Brent was down 2.5% over the last 10 days, down 7.5% year to date, good for inflation. WTI also fell. Natural gas, though, rose in Europe and the US and is now up. In Europe, 17% year to date, UK 18% year to date. That is not good for household bills. So this is Brent. If Saudi open the taps, the only direction for oil prices is down. This is WTI, similar pattern. Numbers specific to the oil market, and all that is happening against a backdrop of continued crude draws in the US. So the US oil market is undersupplied. Crude oil production in the US fell low by 100,000 barrels last week to 13.2 million barrels. The peak this year was 13.4, and the EIA had previously been forecasting that oil supply would grow towards the end of the year. There's no evidence of that yet. Baker Hughes rig count is unchanged at 488. Now, what's going on in Europe? European natural gas prices rose quite strongly over the last 10 days, up 11%. I'm going to read this out. European natural gas futures rose to 34.5 euros per megawatt hour, rebounding from a 2-month low of 33 amid upward demand revisions and supply uncertainty. A Ukrainian news source backed away from an early report that Ukraine agreed to transport Azerbaijani gas to Europe as a temporary measure following the end of Gazprom's 5-year deal. Still, markets remain attentive to whether deals were still being negotiated with Azerbaijan for gas supply to Europe next year. Prices were also supported by expectations for cold snap later in the month, enough to raise gas demand for heating power by 8 million cubic meters per day. On the other hand, Norwegian gas flows to Europe have increased as the Vangelid pipeline is fully operational after maintenance. Gas storage levels are very high at 93.5% ahead of winter. But we're heading into winter. Gas prices tend to rise in winter. This is UK gas prices. Again, up strongly, up 16.6% over the last 10 days. Not good. US natural gas futures are up 10% year on year. Hurrah. Uranium stabilized, but down 11% year to date. Onto industrial metals, and it was off to the races for some of the key industrial metals. Aluminium up 3.7%, copper up 7.8%. They've been helped by dollar weakness and Chinese stimulus. Notice that iron ore did not join in. So this is aluminium heading back towards its highs for the year, up 9.9%. Now, given that we know that manufacturing PMIs are weakening, the market seems to be taking a lot for granted in expecting that interest rate cuts and Chinese stimulus will lead to increased demand for aluminium. Copper again off to the races on the back of expectations for renewed demand growth. Seems to be anticipating a lot. Let's see if the real demand comes through. Iron ore going nowhere. Neodymium stabilizing, having bounced strongly from lows. Nickel rising again. Tin doing okay. Zinc joining in the fun. Onto precious metals. Well, Richard's having a hell of a good time. Gold up 30% year to date. Silver 31%. The PGMs actually not too bad. Platinum 1.2% last week, 3.2% year to date. Rhodium up 7% year to date. Only palladium's doing badly, and that's because it had an extraordinary run before Christmas last year. So this is gold, just seems to be relentlessly rising. And if you look back to the 1970s, gold just rose relentlessly, leading before going exponential. Now, I think that's all related to the Iranian Revolution and fears over structural inflation. But just because gold has risen strongly doesn't mean it can't continue doing so. And this time, the demand is being led by central banks that are switching away from US treasuries and into gold. Saudi Arabia is reported to have bought 160 tons of gold in Switzerland since 2022. But gold is starting to look overextended. When you look at speculative positioning, it's an all-time high. Silver doing very well, up 31% year to date. Platinum going nowhere. And onto rates, and I've had another terrible couple of weeks, so which is incredibly frustrating given that inflation's coming down, but long-term rates in the UK went back up. So the yield curve shifted back up, and you can see now that the 30-year is well above the 1-year. In the US, the 30-year is also above the 1-year, but to a lesser extent. That looks like a normal yield curve to me. Now, the spread over US treasuries that investors charge to lend to the UK has been trending upwards over the past 3 years. And so now, the 30-year, you're getting almost a 50 basis point uplift for lending to the UK by buying UK gilts relative to US treasuries. And that is despite the US having a higher fiscal deficit and a higher debt to GDP ratio. This is a volatile number over time. A part of the UK's inflation problem is due to labour supply. So we showed earlier how the US has let in loads of illegal immigrants. And so the US labour supply has actually grown quite substantially over the last 18 months. The UK labour supply has only just returned to its pre-pandemic levels. And this is the spread between the UK 30-year, that's in green, and the German 30-year, which is in blue. And the UK 30-year yields 4.6%, German 4.49%. So you get almost 85% more interest from lending to the UK than you do from lending to Germany. That's an enormous number. And that suggests that the bond market is very concerned about the UK inflation, and the Bank of England has lost a lot of credibility in the past couple of years. It's the UK 2-year, It's risen substantially over the last few weeks. 10-year bounced back, but this is the 30-year. I've got loads of the 30-year. Terrible for me. P&L heading back towards lows of the year, while the rest of you are all making money. Very frustrating. Now, this is the long-term chart, and I'm fully expecting it to settle somewhere here. So hanging on, very painful. Clearly, I've got this entirely wrong, but it's a long game. Don't panic just because you lost money for a bit. The US 10-year, you notice that pattern very different from the UK. The market thinks that US inflation is under control and the Fed can cut rates. They're not convinced in the UK. This is German 10-year, again, very different pattern. They think German inflation is falling. Concluding comments. Well, the Fed cut by 50 basis points. But the thing is, although US inflation is under control, the US economy is growing just fine. So why do the US need to cut rates much further from here, unless you get further deterioration in the labour market? Let's see what happens. But it seems the market is actually anticipating a lot of cuts in the US that appear unnecessary. China has stimulated its economy. We expect that to have little effect, but it sent the stock market off like a rocket. Oil prices are falling, and that looks to be a structural issue. That's good for inflation. But when you stand back and look at that, Fed cuts, stimulative. Chinese interest rate cuts and cuts reserve ratio, stimulative. Oil prices falling, stimulative. It looks like the world economy is set for a soft landing. Now, Richard should be back next week. In the meantime, how am I doing? Well, I thought rising interest rates would slow the economy, and I've been totally wrong, and it's cost me a lot of money. And frankly, I'm having an incredibly depressing year. I hope you are all doing better. I'm sure you are. So the rise in UK yields was terrible for me. Had a really bad 10 days, taking me back towards the low for the year. Very depressing. But I've done something about it. So I've been liquidating cash, on which I've made a little return, and I've been buying, and this is not all of them, this is most of them, this is all I could fit on the page, real estate investment trusts and other asset-backed investment trusts. Now, the source of all my problems is this, the 2068 gilt, and frankly, I thought a range was developing that it was going to break out of to the upside. Instead, it has once more collapsed towards the bottom of its previous channel. Medium term, I remain convinced that the UK can't live with these interest rates, and its poor performance is reflected in that. But we need to get inflation under control. Let's see what Rachel Reeves does in the budget in next month, 30th of October. So let me take you through what I bought. And in all of these cases, what I'm expecting is that falling interest rates will lead to a rise in the NAV, and for the discount between the share price and the NAV to narrow. And so you get a double bonus as interest rates fall, and in the meantime, you're getting big dividends. So this is the Renewables Infrastructure Trust, which we talked about last episode, but one, dividend yield 7.3%, discount to NAV 17.1%. Big old market cap of 2.5 billion, bought lots of that. The BBGI Global Infrastructure Fund, 6.4%, less of a discount to NAV, market cap 940 million, bought some of that. Sequoia, this is interesting actually. This one invests in bonds. So it invests in the senior and subordinated debt of infrastructure projects. It's got a 16% discount to NAV and dividend yield of 8.6%. And as interest rates fall, the NAV should rise. The HICL Infrastructure Fund shares have been recovering recently. discount, 16.5% discount to NAV, 6.25% dividend yield, big old fund. Greencoat Wind Energy, very popular fund. You see how rising interest rates have just killed the NAV. 12, it's a 12.8% discount to NAV, yield 7.2%, big fund, 3.2 billion. INPP, which we talked about earlier, that's another big fund, 2.4 billion, discount to NAV 14%, dividend yield 6.6%. So you get paid for holding these. This is the Bluefield Solar Income Fund, big dividend yield of 8.3%, 18% dividend discount to NAV. Downing Renewables and Infrastructure Fund, huge discount to NAV. It's a small fund, 32% discount to NAV, 7.2% dividend yield. Impact Healthcare REIT, its share price has been rising strongly, but it's still at a 22.5% discount to NAV, yielding 7.6%. Supermarket Income REIT invests in supermarket buildings. You'll see again how its NAV has been affected by rising interest rates, 17% discount NAV, 8% dividend yield. Urban Logistics, 23% discount NAV, 6.2% dividend yield. Now, beware, REITs can go wrong. Now, this is the Life Science REIT, and it was launched in 2022 to build labs in Cambridge and elsewhere. And it has been slow to get tenants. Now, actually, its results were yesterday and it's announced a dividend. It announced a dividend of 1p, meant interim dividend, and that gives it a yield of around 3.5%, but its shares are down 70% since IPO. If you'd invested the IPO, you're not looking very clever. Now, I actually bought some yesterday because I read the interim statement and the discount to NAV is enormous. And the fact that the finances are stabilizing means that I think that discount will narrow. And when you've got a discount of 60% to NAV, I think the odds are in your favor. Elsewhere in my portfolio, in 2022, when I liquidated all my oil stocks, and thank God I did because they've all collapsed since then, and that was an excellent decision by me. One of the ones I retained was Entech Technologies, which is a tiny company, and it is developing directional drilling machinery. Now, it's been a poor investment. I've been waiting for it to commercialize its technology. Frankly, it's so illiquid that I would struggle to get out of my relatively modest position. And so I've kept hold of it, but it hasn't been good. And the danger for small companies that need to raise money is they do a discounted rights issue. And that's exactly what happens. So as commercialization approached, the share price was beginning to rise, and I thought I could actually make some money on this. But then they did a discounted rights issue discounted fundraising at 5p. Share price has collapsed to 5p, and I'm really not looking very clever. So bottom line is, I really wish I'd sold all my energy shares in 2022 rather than saving the few I did save. Now, in particular, I've kept Diversified Energy for the dividends. Its share price is down about 60%. And Entech Upstream, and its share price is also down 60%. Now, a lot of the other small caps on which I made very good profits, up 100% or more, they have since collapsed in a similar fashion. And I should have been ruthless and cut all the positions. So that's it for this week. Thank you all for watching. Please can you press like and subscribe to the channel. I hope you're doing much better than me. Not difficult. Now, next week, Richard should be back, so it should be a bit more fun for all of us. In the meantime, have a good week. It's goodbye from me, Keith Jordan. Goodbye.
Full disclaimer. The material and information contained in this podcast is for information and entertainment purposes only and should not be relied upon for making a business, legal or any other decision. We may own or have a financial interest in any securities mentioned. Listeners should conduct their own research or consult a professional investment advisor before making any decisions regarding topics mentioned on the show. Whilst we endeavour to ensure that the information presented on the show is correct, we make no representations or warranties of any kind, express or implied, with respect to the podcast and website or to any information, products, services or related graphics discussed or presented in the podcast or website. Any reliance you place on such material is strictly at your own risk. You are solely responsible for the investment decisions you make. We will not be responsible for any errors or omissions in the podcast or website, including in articles or postings, for hyperlinks embedded in messages, or for any results obtained from the use of such information, nor will we be liable for any loss or damage, including consequential damages, if any, caused by a reader's reliance on any information provided by the podcast or website. Please do not listen to the podcast if you do not accept self-responsibility for your actions.